I saw it after the candles had already turned red, sharp, brutal, the kind of drop that rattles even seasoned traders. At first glance, it looked like panic. Headlines screamed, XRP crashes again. Retail forums erupted with fear. And yet, in the quiet corners of the order books, something else was happening, something deliberate. I started tracing the transactions, following the chains like a detective searching for clues. Slowly, methodically, what I noticed was unsettling. Massive wallets moving in whispers, not in shouts. Not the kind of frantic selling you expect from a crash. These were stealthy, calculated acquisitions. One transfer here, another there, small enough to avoid triggering alarms, but cumulatively enormous. The smart money was quietly reclaiming positions while retail was losing their nerve. The charts told part of the story. Red candles, thin volume, temporary support levels crumbling. But the truth, the hidden narrative, was in the microstructure. Empty liquidity pools absorbed retail panic like sponges. Every dip was bought instantly, every surge orchestrated. By the time anyone noticed, the market had already flipped. Then I looked at timing. SEC announcements, ETF delays, institutional chatter, all coinciding with these hidden accumulations. It wasn't coincidence, it was orchestration. And suddenly, the pattern became terrifyingly clear. What felt like chaos to most traders was actually a slow, precise shift in ownership, a silent war between retail emotion and institutional discipline. By the morning, YouTube and Twitter would scream XRP pumps, but I knew better. This wasn't hype, it was a prelude. And the next move, what these whales had been preparing for, was about to change everything. If you think you've seen volatility before, you haven't seen what's coming, because the full story, the wallets, the timing, the hidden signals, is far bigger, far deeper, and far more consequential than anyone talking on social media dares to reveal. And the shocking truth is, most traders won't even realize the opportunity that just passed under their noses. The moment the SEC update hit, I noticed an immediate reaction in the market. At first glance, it appeared to be panic-driven selling. Red candles flashed across charts, support levels wavered, and retail forums erupted with fear and speculation. But the deeper I dug, the more I realized the story was far from simple. The movement wasn't chaotic, it was orchestrated. Behind the headlines, there was structure. Micro-level order flow revealed an unsettling pattern. Wallets moving in deliberate increments, small enough to avoid detection, yet large enough to accumulate meaningful positions over time. This wasn't retail panic. This was methodical positioning. As I traced these wallets, I noticed a pattern forming. Institutional actors, likely anticipating regulatory noise, were quietly reshaping their positions. Liquidity that retail traders expected to absorb selling pressure wasn't behaving normally. Sell walls disappeared, dips were absorbed instantly, and the market was quietly stabilizing beneath the surface. To anyone looking only at price action, this looked like a normal correction. But the truth was invisible unless you examined the on-chain flow and timing of trades. The timing aligned too perfectly to be coincidence. The SEC news acted as a smokescreen, creating uncertainty among emotional traders while providing cover for disciplined accumulation. Early morning dips were absorbed in seconds, leaving retail participants convinced the market was collapsing. Yet, behind the curtain, the accumulation continued quietly, almost imperceptibly, establishing control before the wider audience could react. By the time mainstream commentary caught up, the structural shift had already occurred. The announcement didn't trigger the move, it masked the orchestration that had been in play for days. I realized that anyone relying solely on headlines was seeing only the surface of the market, while the deeper forces were quietly flipping ownership. The real narrative wasn't about volatility, it was about stealth, precision, and control. And if I didn't trace these movements carefully, I would have missed the single most important market shift in recent XRP history. Tracking the largest wallets revealed the first layer of the invisible narrative. These weren't the obvious holders you hear about on social media. They were cold, methodical actors moving in measured increments. I noticed transfers repeated in patterns that suggested coordination. Large quantities of XRP were shifting, but each individual transaction was subtle enough to escape detection, like shadows moving through a dark room. Over time, these small movements accumulated into a massive change in market positioning, one that retail participants could neither see nor influence. What struck me was how precise the accumulation was. There was no panic, no noise, no chaos, only discipline. The whales absorbed dips, reinforced key support levels, and carefully timed purchases to avoid slippage. It was almost surgical. Watching this unfold in real time felt like observing a chess grandmaster playing multiple boards simultaneously. Each move had intent, each pattern had purpose. By comparing multiple wallets, I realized these weren't isolated actors. Several whales were acting in parallel, seemingly without direct communication, yet their actions harmonized. Dips were absorbed, liquidity was manipulated subtly, and retail traders panicked into selling precisely when these wallets were buying. The result was a controlled transfer of ownership, almost invisible to the naked eye, but enormous in cumulative effect. This silent accumulation revealed a crucial insight. The market wasn't driven by headlines or sentiment. It was controlled by those who understood timing, liquidity, and order book mechanics. Retail participants were blind to these forces. They reacted emotionally, often at exactly the wrong moments, while the whales quietly strengthened their positions. I realized that by the time anyone noticed the price movement, the battle had already been won. By midday, a sudden drop hit the charts. Red candles dominated, panic set in, and retail traders feared a full-scale collapse. But the microstructure told a different story. As the price fell, the order books revealed massive absorption of sell pressure. The dips weren't left unguarded. Instead, large wallets quietly snapped up XRP, stabilizing support levels. What appeared to be a market failure was actually a carefully executed reinforcement strategy by sophisticated players. The sudden dump highlighted the emotional gap between retail and institutional actors. Panic drove retail selling, triggering minor liquidity gaps that allowed the whales to purchase more without significantly moving the market. The irony was stark. What retail saw as chaos, the whales saw as opportunity. Each dip was used to their advantage, and by the time the wider market reacted, the accumulation had deepened. I tracked wallet movements during this period and noticed that multiple accounts coordinated timing. While the broader market flailed, the silent actors executed precision buys that reinforced key support levels and absorbed volatility. Red candles flashed like alarms, but the underlying structure remained intact. Retail participants mistook the volatility for genuine risk, never realizing that the foundation of the next move was being built beneath their noses. This moment was a microcosm of the market's psychology, emotional traders responding to perceived fear, while disciplined actors quietly reshaped ownership. By the end of the session, the market had flipped subtly, unnoticed by the public. It wasn't a crash, it was a carefully orchestrated redistribution, executed with precision and patience, and the lesson was clear. Understanding microstructure and hidden accumulation is far more valuable than following price headlines. By the afternoon, mainstream coverage framed everything as a panic-driven episode. Tweets claimed XRP crashes, YouTube analysts highlighted dramatic losses, and social media amplified fear. But what the media didn't show was the hidden narrative. Red candles and sudden dips weren't the story, they were the backdrop. The real story was in the micro-level accumulation, the quiet reinforcement of support, and the timing of strategic buys. Tracking the wallets in real time revealed coordination invisible to casual observers. Massive positions were being acquired incrementally, executed in ways that avoided slippage and minimized market reaction. Retail participants, distracted by sensational headlines, were unaware that the ownership structure had already shifted. This is the gap that separates emotional traders from informed participants, the ability to read between the lines of apparent chaos and uncover the orchestrated narrative beneath. The media also ignored the timing relative to regulatory events. SEC updates, ETF delays, and public commentary created emotional reactions among retail traders. Meanwhile, institutional actors were positioning silently, anticipating these events and leveraging them to acquire positions unnoticed. The disconnect was staggering. Public perception suggested disorder, but under the surface, accumulation was precise and disciplined. By evening, the narrative had already diverged from reality. Retail traders were chasing fear and speculation, while the whales and institutions quietly solidified control. The lesson was unmistakable. Headlines are lagging indicators. The signals hidden in on-chain data, order book depth, and incremental transactions are what truly dictate market dynamics. Those who fail to recognize this will always be reactive, never proactive, and in this case, failing to see the silent accumulation could prove costly.